So one of the main reasons why I love real estate investing is that there's so many ways to design your lifestyle based on how you invest in real estate. Maybe you can relate to this, but I have really bad shiny object syndrome. And basically what that means is that every time there's a new opportunity that's shiny and sexy, I get really drawn to that and I drop everything that I'm doing to go do that new thing. And that's the reason why I've had so many small businesses, but each time I would get distracted by a newer, sexier business model. First, in college, it was Amazon FBA, then it was dropshipping, and then it was Airbnb rental arbitrage, and the list just goes on and on. And if you watch Bigger Pockets, which is like the #1 resource for investing in real estate, they have a similar pattern. Like they need to grab your attention. And so they're always pitching this new style of investing that's like super sexy. And don't get me wrong, I love Bigger Pockets, but it's always a new theme. It's like flipping homes, creative financing, subject to, wholesaling, the list goes on and on as well. But the problem that I'm seeing is that a lot of new investors get shiny object syndrome with all these new real estate investing strategies, and they can't choose one. At the end of the day, I realized that all those real estate investing strategies work, but you really need to double down on one strategy and take it all the way if you want to get big. So for me, making a decision on what strategy I wanted to use became a lot easier for me once I realized two things about myself. Number one, I'm lazier than I want to admit to myself. And number two, I don't need to start a super successful business to reach financial freedom. Luckily for me, I have a high-paying W-2 job where I have savings every single month. And if I invest those savings conservatively, I'll still be able to reach my financial goals. So because of those two realizations, I came up with this criteria that allows me to determine whether or not a real estate investing strategy is worth pursuing. So that criteria for me is that number one, it can't take more than 10 hours per week. Number two is I didn't want to start an active real estate investing business like wholesaling. And number three, the dollars per hour spent in this activity needs to be very high. So with that said, based off the last 5 years of real estate investing strategy research, here are the top 3 real estate investing strategies that I think fit my criteria the best. And I'm pretty much just ignoring every other real estate strategy because it doesn't fit my criteria. So those 3 strategies are buy and hold, syndications, and short-term rentals. So let's talk about the first option, which is buy and hold. Now, this is my favorite option on this entire list, and I love buying and just holding. So one of the main reasons why I love buying and holding so much is that the work required comes in short bursts. And what I mean by that is that there is initially a lot of work to find the property and put tenants inside. But once you have tenants inside, a lot of that initial work kind of drops off, and maintaining the property and managing the property is actually pretty easy. For example, when I bought my second investment property, it took me about a month of looking on Redfin, Zillow every day to basically find the property that I liked. So once I closed on that property, I had to find tenants. So I listed my place on Zillow, and then I found tenants, basically signed a lease with them, and then I painted like 2 of the bedrooms white. So in total, maybe like 15 hours. But once the tenants signed the lease and moved in, I'd only get occasional text messages here and there saying that the sink is broken or that the shower head is broken and it needs repair. So then I'd pick up the phone, call my handyman, and then within one phone call, I could have that thing fixed. Now, to be honest, all homes aren't built equal. So you are gonna have some of those troublesome homes, and you're gonna have some of those homes that are just like perfect. But to be completely honest, the workload for managing these rental properties is never like evenly spaced out. Over the past 2 years, my experience has been that when there are issues, they come in like small bursts, and then you might not hear from a tenant for like 4 months. This past winter time in California, there was a storm that passed through Livermore, which is where my rental properties are, and it caused one of my fences to blow down, and it caused a water leak in the other home. So for the fence that blew down, I had to call the insurance company, I had to hire a fencing guy, I had to call the neighbors, so I had to place maybe like 20 phone calls in total. And then for the water leak in my other rental property, I had to call the roofing company because I had a warranty on my roof, and then I had to call my handyman to fix the hole in the ceiling. So the question is, why do I still love buy and hold rentals despite all of this? Because between those 2 rental properties in 2022, not only did I save $100,000 in federal income tax off my W-2 income, I also collected $57,000 of rental income tax-free, and I have my tenants paying down my loan for me every single month. Not to mention that both my homes are appreciating over time as I hold on to them. So let's just say I spent 100 hours on both rental properties in 2022, which I think is generous. If we just compare that just to the tax savings of $100,000, that means that I saved $100,000 with just 100 hours of work. So if you calculated the dollars per hour on that, that's like $1,000 per hour. So while everybody is talking about passive income in real estate investing, to be honest, it's not that passive. Now, I can go hire a property manager, but I'm okay with making $1,000 per hour. I honestly treat it more as like a part-time job than this passive income completely no work type of deal. But again, buying and holding still fits my criteria so perfectly. So I would say that I'm spending maybe 1 hour a week in total to manage both my rental properties right now. And then the second criteria is that it's not an active business. I would consider this a more passive business. And then the third criteria is that, again, it's a very high dollar per hour job or passive income. Now let's talk about the second strategy that I like a lot, and that is syndications. So if you don't know what a syndication is, here's a 20-second rundown. So a syndication is a type of business model where instead of one investor buying one property, basically a group of investors, aka limited partners or LPs, pool their money together to buy a bigger asset. Now, normally the LPs are accredited investors, which basically means that they make over a certain income threshold per year, or they have a net worth of over $1 million. Now, there are deals for non-accredited investors, but those are less common. So in a syndication, there's always going to be another layer in between the asset and the investors, and that middle layer is going to be the operators, aka the general partners or the GPs. And the job of the GPs is essentially to find the real estate investment opportunities, pitch them to the investors, collect money from the investors, and then purchase and manage the property, and then increase the value of those properties by raising the rents on those properties, and then distributing the profits equally to the investors who invested in that deal based on however much that investor invested. And then the GPs make money based on like fees like acquisition fees, and then when you exit, they get a small portion of the profit as well. Now, obviously being a GP in a syndication is very hands-on, very active, so that's actually not the role that I'm talking about. I'm actually talking about the role of an LP, because the role of an LP in a syndication is literally just to hand money to the operator and then collect a check. So here's a standard offering for LPs that I've seen from GPs that I've talked to. So the deal is usually structured in a way that the LP will get an 8% preferred return. So I'm not gonna go into the details of what preferred return means, but basically if you invest $100,000, then over the next 4 quarters or the next year, you're gonna basically make $8,000. So that basically means that you'll collect a check for $2,000 pretty much every quarter. The second part of the offering is the equity multiple. That basically means that if you give us $100,000, we're gonna turn this $100,000 into $200,000 after 5 years, after we've raised the value of the asset. So typically the hold period is anywhere from like 3 to 7 years. And after they sell or refinance the property, the profits from the sale will be evenly distributed to the investors based on how much you invested. One of the other benefits of investing in syndications is the tax benefits. So when you invest into a syndication, you're technically owning a small fraction of that real estate asset. So you're still technically owning real estate. And so you get the same exact tax benefits as if you were to buy that real estate yourself. So that tax benefit is manifested in the form of passive losses. So as an LP, you get access to passive losses when you invest into the syndication for the very first year that you invest into that syndication. And you can use passive losses to offset other forms of passive income. For example, if you have a short-term rental that profited $100,000, you might consider putting that $100,000 into a syndication and using the passive losses from the syndication. Let's say you get $70,000 of passive losses to offset some of that income from that short-term rental. And then lastly, the minimum investment for investing into a syndication is anywhere from like $25,000 to $100,000. Now, the thing you have to understand about syndications is that as an LP, the only work that you need to do is to vet the GPs. So most of your work as an LP is going to be front-loaded again, because you're going to have to go interview those GPs, right? Because there's multiple GPs who run multiple different syndications. So you have to find the right syndication, and then you have to review the PPM. And PPM stands for Private Placement Memorandum. And basically it's like an investment summary of what they're going to invest in, how they plan to finance it, how they plan to raise the funds and raise the rents for that asset, and eventually, sell the asset for a much higher price later down the road. Also, one of the main things that I look for in a GP is track record. Like, how many times have they done this successfully and achieved what they said that they were going to achieve? So it's your job to scrub that PPM and make sure that all the assumptions that they make inside that PPM make sense and are conservative. If they say in that PPM that rents are going to grow 30% in 1 year, you might want to run really far away. So now if you invest into a syndication, let's say you throw in $100,000 and you wait 5 years. Well, during those 5 years, you're making 8% each year. So after those 5 years, you've made a total of $40,000 just from the preferred return. And then on year 5, when they sell, let's just say you get about $60,000 of capital gains. So that means that over the course of 5 years, you made a profit of $100,000 and you get back your initial $100,000. So you basically doubled your money in 5 years. So again, syndications meets all my requirements. It's very passive. It's probably the most passive way to actually invest in real estate. And again, the dollars per hour are infinite, I guess, because you don't really work or do anything. So that brings me to my last strategy, which is short-term rentals. So I have a special place in my heart for short-term rentals, and that's because the very first rental property that I bought was actually a short-term rental down in Joshua Tree, California. Long story short, I bought it for $227,000, fixed it up a little bit, put some furniture, ran it on Airbnb, profited about $20,000 after all expenses, and then exactly a year later, I sold it for $485,000. That one property more than doubled my net worth, and so you might be able to understand why I love short-term rentals. But in my opinion, since then, short-term rentals have become a very hot topic and everybody wants in. But in my opinion, I see that the travel boom is kind of over at this point, and there's a lot of people who went and bought these short-term rentals for like $100,000 for over asking because they really wanted to get into the short-term rental game. So obviously I'm not gonna go spend $100,000 over asking just to compete with people like that. But at the same time, I still see a lot of potential for short-term rentals, especially for the 1% listings. And when I say the 1% listing, I pretty much mean like the best of the best listing. These are usually properties that are fully renovated solely for the purpose of doing short-term rentals, and they do amazing on Airbnb. Now, obviously this strategy is a lot more on the active side than it is on the passive side, but considering how much profit one Airbnb can make, I still think it's worth it for me to do a short-term rental. The only difference is that if I were to do Airbnb again, I'd probably be building a new construction build that's specifically made for short-term rentals so that I can be a 1% listing. I'd be going all out, and I'd be making short-term rentals that look something like this, or like this, or like this. I truly believe that if you go all out and just build something super crazy that nobody's ever seen, you're gonna be a 1% listing and you're gonna be completely booked out and you're gonna rake in profits. And also, if you pair this strategy with the short-term rental loophole, which is probably the best tax strategy for W-2 employees to help you pay less federal income tax in 2023, I think that's probably one of the best strategies for growing your net worth in 2023. So if you wanna learn more about the short-term rental loophole, you can go check out that video right here. So that's it for today's video, guys. If you guys liked the video, please give me a thumbs up and consider subscribing if you guys want more videos just like this one. Hopefully this video gives you a little bit more insight as to what options really work for you in your lifestyle. So if you have any other questions or comments, just leave them in the comments section down below and I'll get to answering them. Otherwise, feel free to schedule a one-on-one consultation with me. The link is in the description below. So thanks for watching, guys, and I'll see you guys in the next video. Peace out, guys.